Benefits of the United States tax code in your real estate portfolio. That's the topic for today's episode. And without further ado, let's dive in. Hello everyone, and welcome back to another episode. For those who are tuning in for the first time, this is your channel for real estate education. So I've been getting a lot of questions related to taxes, related to how to take the best advantage of having an LLC or having an investment property. So I decided to create an episode at a very high level to talk about the benefits in real estate based on my experience and based on what I know. Now, with the caveat, I am not an accountant, I am not a specialist in taxes. I'm just simply sharing my experience with you, given that I have filed taxes as an investor, so that way you kind of like get an overview of what benefits you get out of reporting your rental income, and not just in terms of taking advantage of the code, but at the same time getting access to funding as well. So let's just go into the board, and first things first, let's consider what type of expenses you will normally have when you have a rental portfolio, right? So the first thing are what they call fixed operating expenses, and then you have some that are called the variable ones as well. So what exactly is something that is fixed? So let's say, for example, property taxes is definitely a fixed one, right? You can have a property manager as well. If you decide to hire one, that becomes a fixed cost because you have to pay for those services every month, right? You have utilities in the equation, and that's it at a high level what you have. The variable cost could be any one-off expenses that you have to repair. So we're gonna put repairs over here, and maybe mortgage interest, because not all of us will have a mortgage on a property. Some of us manage to buy our property cash. So that is, in essence, the way I view it, it's a variable cost, which means here, interest, right? So let's say on a monthly basis, you spend roughly about $100 in each of these categories. So that means that on a monthly basis, you spend $300 in fixed operating expenses. And then at the end of the year, let's say just at a variable level, it will be, I don't know, I'm just throwing a number out there, $700, right? So when you take this number and then you take this number right here, this, we gotta multiply that by 12 because it's gonna be an annual number. So that comes up to be 3,600. And then 3,600, when you add $700 to it, that becomes $4,300, 4,300, right? That's gonna be your cost annually to maintain or to manage your real estate portfolio. Now, let's just say, for example, that you are getting $1,200 a month for rental income, right? For every $1,200 a month, you will multiply that by 12, right? Which in essence turns out to be $4,400, right? So now what you're gonna do is just to take this $14,400 and then you're gonna minus $4,300 into it, and therefore your net income becomes $10,100, right? So the incentive that you get out of the tax code is that these costs are taken into consideration. And what the government does is that you're gonna receive credit. You're gonna receive some sort of like a discount for having to incur that cost. Because you're running a business, they're giving you an incentive to continue to do so. And therefore, they're giving you a discount due to your operating expenses, right? So instead of paying taxes off of $14,000, 400, you're actually paying taxes off of $10,000, 100. So let's say, for example, and I'm just gonna throw a simple number out there, that your tax bracket is 30%. Would you prefer to pay 30% of 14,400, or do you prefer to pay taxes 30% off of $10,100? Which one is it, right? So that's in essence what it is. Now, another perk that you get out of reporting your rental income and at the same time taking advantage of the discount is that when you go and apply for a residential mortgage, you do get approved for more money. So let's say, for example, your annual salary is $50,000, right? And I think I mentioned in another episode, and if you have no idea what I'm talking about, don't worry, there's going to be a link to a playlist down below so you can watch more and learn more about the subject. But let's say you make $50,000 a year, and depending on your credit profile, the banks are going to lend you either 3 times or 4 times that income. So that can translate to 150,000 or 200,000, right? But when you declare your rental income, you're basically adding this amount to it. So out of $50,000 plus 14,400, that means you are making, or you are declaring, over $64,000, 64,400 to be exact, annually. And 3 times that is going to give you the following. Let me just grab my calculator because I want to make sure I give you the exact amount. So let's say 64,400 multiplied by 3, that will give you 193,000. I'm just going to round it up. And if you were to qualify for 4 times that amount, depending on your credit profile, you will get access to $257,600, right? So my question to you is, which one would you rather have? Would you rather not declare anything or not report your rental income and therefore let go of the benefits that you're getting from getting the benefit that you're receiving for acknowledging your expenses, and therefore qualify for less money in terms of funding for your real estate portfolio? Or do you prefer to do that, take advantage of the incentives that you're getting to deduct your expenses from your taxes, and at the same time qualify for more money and rentals? 193 to 257 versus 150 to 200. Which one is it going to be, right? And again, it's all about keeping yourself informed. It's all about knowing exactly what to look for. And now you know. That's why it's very important for you to keep copies of those receipts for every payment that you make in terms of repairs, any mortgage interest that you have, any property taxes, because at the end of the year, this is what you're going to be given to your accountant so they can take into consideration all of these and apply those to your benefits, and at the same time help you qualify for more money. Because at the end, when you apply for mortgages, remember, the first thing the lenders ask is for a copy of your tax return, and that's how they validate that you in fact are running a business portfolio, you're running a real estate portfolio, and they want to account that income to your benefit so you can qualify for more money. So that's it. That's all I have for today. Hopefully you find the content valuable, and do not forget to share the love with someone that you know is going to benefit from this content. And until then, I will see you guys next time. Take care. Bye-bye.